Imagine it is October of 1930. You are a farmer in rural Nebraska. You have worked the same land for 30 years. You know the soil, you know the weather. You know that one bad season can change a family's life, and one good harvest can carry you through the winter. Last month you sold your grain and deposited the money into the local bank to you. That money is not an abstraction. It is next spring's seed. It is the family's food. It is the repair on the barn roof. It is the doctor bill if a child gets sick. It is the difference between surviving the winter and becoming desperate. On Tuesday morning, you drive into town to withdraw a small amount for supplies. There is a line outside the bank. At first you think it is a delay, then you see the faces. People are not waiting patiently. They are whispering, arguing, staring at the door. Some are angry, some are afraid. The doors are locked. There is a handwritten sign taped to the glass, closed until further notice. You step forward, you knock. A clerk inside looks at you and then looks away. He does not open the door. He does not explain. He does not make eye contact long enough to make a promise. Your money is still inside the building. You can see the bank, you can see the vault, you can see the place where you believed your savings were safe, but you will never touch that money again. That is the part people do not understand about banking crises. The money does not vanish because you gambled. It does not vanish because you speculated. It does not vanish because you bought stocks at the top or chased a mania. It vanishes after you did what society told you was responsible. You deposited it, you trusted the system, and the system failed. This is not a fictional fear. It is history. In the early 1930s, thousands of American banks closed. Families lost savings, businesses lost payroll, farmers lost seed money, small towns lost the institutions that held their economic lives together. When people remember 1929, they usually remember the stock market crash. Black Tuesday, the Dow falling, speculators wiped out. But the deeper economic damage came from the banking system. The crash was the spark. The banking failures were the transmission mechanism that carried the fire into ordinary households. That is why this history matters now. Not because 2026 is 1930. History never repeats exactly. It rhymes because the same human incentives, the same balance sheet structures, and the same confidence dynamics reappear under different names. The language changes, the machinery becomes more sophisticated, the legal framework becomes more complex. But the basic architecture remains recognizable. When you deposit money into a bank, you are not placing your cash into a personal vault with your name on it. You are lending money to a private institution. The bank becomes a debtor. You become a creditor. The bank owes you money, but the actual cash has become part of the bank's balance sheet. That distinction is everything. Most people think a bank account is storage. It is not exactly storage. It is a claim. A claim is only as good as the institution's ability to honor it, the legal framework around it, and the government's willingness and capacity to support the system under stress. In normal times, the distinction does not matter. You swipe your card. You transfer funds. You withdraw cash. Your paycheck arrives. The illusion of perfect access feels like ownership. But access and ownership are not the same. Access can be delayed. Access can be restricted. Access can be frozen. Access can depend on solvency, liquidity, regulation, insurance, politics, and confidence. That is why the first principle is simple. A bank is not a vault, it is a counterparty, and counterparties can fail. Now, I am not saying banks are evil. That kind of thinking is not useful. Banks are part of the economic machine. They create credit. They finance homes, businesses, farms, factories, and consumption. They help money move. They provide convenience. They are essential to the modern economy. But machines have designs, and designs have vulnerabilities. To understand the vulnerability, you have to understand fractional reserve banking. When you deposit money in a bank, the bank does not keep all of it sitting in a vault waiting for you. It keeps a fraction and lends or invests the rest. That is how banking expands credit. If you deposit $1,000, the bank may hold a small portion in reserve and lend out the rest. The borrower spends that money. It is deposited somewhere else. Another bank lends out most of that deposit. The process continues. A single original deposit can support a much larger amount of credit across the system. That is how the money multiplier works. In calm conditions, this system functions beautifully. Not everyone needs their money at once. Deposits come in, withdrawals go out, loans are repaid, banks earn interest, households and businesses get credit. Economic activity expands. But there is a hidden fragility. The bank's liabilities are short-term. Depositors can ask for money quickly. The bank's assets are often long-term. Loans and bonds cannot always be turned into cash instantly without losses. That mismatch is the heart of banking risk. Short-term promises backed by long-term assets. The system works as long as confidence holds. Confidence is the load-bearing wall. When confidence breaks, the mathematics change quickly. If too many depositors ask for cash at the same time, the bank cannot meet all withdrawals. It is not because every dollar was stolen. It is because the dollars are not sitting there in the form depositors imagine. They have been transformed into loans, securities, and longer-term assets. That is why bank runs are so dangerous. They are not just reactions to insolvency, they can create insolvency. A rumor becomes a line outside the bank. A line becomes a withdrawal wave. A withdrawal wave forces asset sales reveal losses, losses confirm the rumor, then the bank fails. This is what happened across the United States in the early 1930s. One bank failed, depositors at nearby banks became afraid. They withdrew money just in case, but just in case became the cause of the next failure. Fear became contagious. Banking is built on trust. When trust becomes contagious in reverse, the system can break fast. In 1930, the Bank of the United States collapsed in New York. Despite its name, it was not a government institution. It was a private bank with hundreds of thousands of depositors. When it failed, the psychological damage spread far beyond its balance sheet. People began asking the question they should have asked earlier: is my bank really safe? Once enough people asked that question at the same time, safety disappeared. Between 1930 and 1933, more than 9,000 banks failed. Deposits were wiped out, savings disappeared. People who believed they were conservative discovered that the most conservative-looking place to hold money was not risk-free. The government had not yet created modern deposit insurance. There was no FDIC to reassure small depositors. The Federal Reserve existed, but it did not act with the force that later generations expected. Liquidity was not provided in the way the system needed. The result was a collapse of trust and a contraction of money and credit that deepened the Great Depression. This is the key lesson. The stock market crash hurt investors. The banking collapse hurt everyone. It attacks savings, payroll, business operations, farms, and local economies. That is why understanding banking risk matters even if you never buy a stock. Now, after the crisis, the United States created the Federal Deposit Insurance Corporation. The goal was to restore confidence. If depositors believed their money was insured, they would be less likely to run. If they did not run, banks would be less likely to fail. This was a powerful reform. Deposit insurance changed behavior. It made small depositors more secure. It stabilized confidence. It reduced the risk of classic bank runs. It became one of the main pillars of the modern banking system. But deposit insurance has limits, and those limits matter today in the United States. Standard FDIC insurance covers up to $250,000 per depositor, per insured bank, per ownership category. That is an important protection. But it is not the same as saying every dollar in every account is guaranteed in every circumstance. The Deposit Insurance Fund is not designed to pay every insured deposit in the entire banking system at once. It is designed to handle bank failures under normal or moderately stressed conditions. One bank here, a cluster there, a manageable resolution process. In a truly systemic crisis, the fund would need support. That support would likely come from the Treasury or Federal Reserve mechanisms, which ultimately means government backstops, emergency liquidity, and possible money creation. That is not the same as pure insurance. It is a confidence system backed by state capacity that does not make it useless. It makes it conditional. A serious investor must distinguish between protections that work under ordinary stress and protections that require extraordinary political action under systemic stress. Those are not the same. The collapse of Silicon Valley Bank in 2023 was a modern reminder. Many of its deposits were above the insured limit under the ordinary legal structure. Those uninsured depositors were exposed. The government stepped in and protected all depositors because policymakers feared broader contagion. That decision may have been necessary to prevent panic, but it was discretionary. That is important. If your deposits exceed insurance limits, your outcome may depend on whether regulators decide the failure is systemically important enough to justify extraordinary support. That means your safety is not only a function of law, it is also a function of judgment, politics, contagion risk, and timing. That is not perfect safety, it is uncertainty, wrapped in reassurance. And even insured depositors can face practical delays. When a bank fails, access may be interrupted while regulators arrange a transfer, sale, or payout. Often the process is fast. Sometimes it is not, if you need the money that day. Even a delay matters. This is why the phrase safe cash needs definition. Safe from what? Safe from bank failure, safe from inflation, safe from theft, safe from government restriction, safe from market volatility, safe from currency debasement, safe from being inaccessible during a crisis. There is no single asset that is safe from every risk. Every form of cash storage solves one problem while creating another. That is the mature way to think about it, not where can I put money so nothing bad can ever happen. That place does not exist. The better question is, what risks am I trying to reduce, and what risks am I accepting in exchange? Now consider physical cash. Paper currency held outside the banking system has one clear advantage. It is not a bank deposit. It cannot be bailed in by a failing bank. It does not depend on a bank's website working. It cannot be frozen by a bank compliance department in the same way a digital balance can be frozen. In a deflationary banking collapse, physical cash can be powerful. During the Great Depression, prices fell. Cash gained purchasing power. Those who had access to cash had optionality when others did not. But physical cash has major weaknesses. It can be stolen, it can burn, it can be lost, it earns no yield. It is difficult to store safely in large amounts. It can become impractical as cash use declines. And in an inflationary environment, physical currency loses purchasing power every year. In hyperinflationary environments, holding the local currency in paper form can be disastrous. The money may still be physically in your hand, but its ability to buy food, fuel, or shelter collapses. So physical cash is not simply safe or unsafe. It depends on the type of crisis. Deflationary crisis favors cash. Inflationary crisis punishes cash. Bank access crisis may make cash useful. Long-term purchasing power crisis makes cash dangerous. That is the trade-off. Next, consider Treasury securities. When you buy a U.S. Treasury bill, note, or bond, you are lending money directly to the federal government rather than to a private bank in the dollar system. Treasuries are generally treated as the safest dollar-denominated assets. They are the collateral foundation of the financial system. Treasury bills, especially short-term bills, can be a useful cash management tool because they reduce bank counterparty exposure. But here, too, there are details. If you hold treasuries through a brokerage, you have some brokerage infrastructure risk. Your securities should be segregated, and there are protections such as SIPC in the United States. But a brokerage failure can still create delays and administrative complications. If you hold treasuries directly through Treasury Direct, you reduce intermediary risk. But Treasury Direct can be less convenient, less flexible, and slower for certain transactions. Selling quickly may require moving securities through additional steps, so treasuries reduce bank risk. They do not eliminate all access risk. They also depend on the solvency and credibility of the U.S. government, the functioning of the dollar system, and the ability to maintain purchasing power after inflation. Again, every solution has conditions. Money market funds are another option many people treat as cash. They are not bank deposits. They are securities that invest in short-term debt. Some invest in government securities. Some invest in prime instruments. They can offer yield and liquidity. They are often used as cash equivalents. But they are not identical to cash. In 2008, the Reserve Primary Fund broke the buck. Its net asset value fell below $1 per share after exposure to Lehman Brothers debt. Investors panicked, redemptions were restricted. The government intervened to stabilize the money market system. That episode taught an important lesson. Cash-like is not the same as cash. A money market fund may be very low risk, but it still sits inside a market structure. It can face liquidity stress, redemption pressure, and policy intervention. The question is which type of money market fund you hold, what it owns, how it manages liquidity, and what role it plays in your overall cash plan. Gold and precious metals are another category. Gold has been a store of value for thousands of years. It is not someone else's liability. It cannot be printed by a central bank. It exists outside the bank deposit system if held physically and directly. In periods of monetary distrust, gold often becomes more attractive. But gold has trade-offs too. It produces no income. It can be volatile. It must be stored securely. It can be stolen. If stored in a bank-safe deposit box, it may still be inaccessible during a bank holiday. If stored through a custodian, you reintroduce counterparty risk. And history contains an uncomfortable example. In 1933, the U.S. government restricted private ownership of gold bullion through Executive Order 6102 and required many Americans to turn in gold in exchange for paper dollars. That does not mean the same thing will happen again. It means that even assets outside the banking system can be affected by government action. Silver and other metals have related properties, but different risks. They can be more volatile, more industrial, less compact in value, and harder to store in large wealth amounts. Precious metals are not perfect safety. They are one tool for a certain set of risks: monetary debasement, currency distrust, and banking system concerns. Then there are foreign currencies and foreign accounts. Some people diversify by holding money in strong foreign currencies or in banks located in jurisdictions with different legal systems. Swiss francs, Singapore dollars, and certain other currencies may appeal to people thinking about geopolitical or currency diversification. This can reduce exposure to one country and one banking system, but it adds complexity. There is currency risk. Exchange rates move. A foreign currency can strengthen or weaken against your home currency. There are tax rules, reporting rules, account opening requirements, foreign legal systems, and sometimes political risk. For Americans, foreign financial accounts above certain thresholds must be reported. Failure to report can carry severe penalties. So offshore banking is not something to do casually, secretly, or without professional advice. Done properly, it can add resilience. Done improperly, it can create legal and tax problems larger than the risk you are trying to avoid. The principle is legal diversification, not concealment. That distinction is critical. Real assets are another form of diversification. Land, property, productive assets, commodities, and other things that exist in the physical world can hold value differently from bank deposits. They cannot be bailed in like an uninsured bank deposit. They may provide utility. Land can produce food. Property can provide shelter or rental income. Productive assets can generate cash flow in inflationary periods. Real assets can outperform financial claims because replacement costs rise and nominal prices adjust. But real assets are not liquid. You cannot easily spend a farm. You cannot sell a building instantly at a fair price during a crisis. Real assets can fall in deflationary periods because credit contracts and buyers disappear. They can be taxed, regulated, damaged, seized through legal processes, or become expensive to maintain. So real assets reduce certain financial system risks, but add liquidity and management risks. Again, no perfect answer. That is the uncomfortable truth. There is no place to store cash that is safe from every possible crisis. Physical cash protects against bank closure but loses to inflation. And theft. Treasuries reduce bank counterparty risk but depend on government credibility and access systems. Money market funds can offer liquidity and yield but remain securities subject to market stress. Gold protects against monetary distrust but can be restricted, stolen, or difficult to access depending on storage. Foreign accounts diversify jurisdiction but add currency, tax, and legal complexity. Real assets protect against certain financial claims but are illiquid and can fall in deflationary stress. The trap is believing that one answer solves all problems. A better approach is layered resilience. You do not ask, what is the one safest place? You ask, what combination gives me access, purchasing power, liquidity, legal clarity, and survivability across different environments? That is how wealthy families think. They do not place all trust in one institution. They maintain optionality. They may hold some bank deposits within insurance limits, some treasury bills, some brokerage liquidity, some physical cash for short-term disruptions, some real assets, some precious metals, some international exposure if appropriate, some productive investments that can grow over time. The exact mix depends on the person. But the logic is the same. Do not let one failure mode destroy your life. Now, let us go back to history. In 1929 through 1933, the people who suffered most were often ordinary depositors, small-town families, farmers, local businesses, people without political power or sophisticated advice. They trusted the system because they had been told the system was safe. The wealthy in many cases had more options. They had access to information, relationships, larger institutions, government bonds, gold, and legal advice. Not all of them escaped losses, but many had more tools. This pattern repeats in Cyprus. In 2013, uninsured depositors took direct losses through a bail. In deposits above €100,000 at major institutions were converted or written down. Capital controls limited access and transfers. Even those not directly haircut faced restrictions. In Argentina in 2001, the government froze bank accounts in what became known as the Corralito. Depositors could not freely access their funds. Peso deposits were converted under unfavorable conditions as the currency devalued. The middle class was devastated. In each case, people learned the same lesson too late. A balance in a bank is not the same as full control. The system may say you own the money, but under crisis conditions, the rules of access can change. This is not a moral statement, it is a structural statement. Systems protect themselves first. Banks protect their balance sheets, governments protect the financial system, regulators protect stability. Depositors believe the system should protect them, and sometimes it does, but not always in the way they expect. That is why the uninformed often pay the highest price. Modern banking is even more interconnected than the banking system of 1930. Derivatives, interbank lending, securities portfolios, payment rails, and cross-border exposures create complex chains. A problem in one place can move quickly. Interest rate risk is a modern example. When interest rates rise quickly, the market value of long-duration bonds falls. Banks that bought long-term securities during low-rate periods can face large unrealized losses. If depositors remain calm, the bank may hold those securities to maturity. If depositors demand money and the bank must sell, unrealized losses become realized. That is what made Silicon Valley Bank so important as a lesson. The bank held a large portfolio of securities that lost market value as rates rose. Its depositor base was concentrated and uninsured. When confidence broke, deposits left quickly. The bank had to raise liquidity, losses became visible, the run accelerated, the collapse happened fast. Modern bank runs do not require people standing in a line outside the branch. They happen through phones, wire transfers, group chats, and corporate treasury decisions. A run that once took weeks can now happen in hours. That is a major structural change. Technology makes banking more convenient in normal times and more fragile in panic. Emergency facilities can stop contagion, central banks can create liquidity, regulators can merge failed banks into stronger ones, governments can guarantee deposits. But every rescue has a cost. If the government protects all deposits, moral hazard rises. If the central bank creates liquidity, inflation and currency risk can rise. If rates are cut to support banks, inflation may return. If rates stay high to fight inflation, bank balance sheets remain pressured. There is no painless path. That is the trap policymakers face. This is why I do not analyze banks only by asking whether there is a regulation or an insurance program. I ask what happens when the system is stressed in more than one direction at once. What if banks are pressured by unrealized losses and deposit flight? What if inflation is still too high for the central bank to cut aggressively? What if the government is already highly indebted? What if depositors are above insurance limits? What if the political environment makes bailouts unpopular? What if digital banking accelerates, runs faster than regulators can respond? These are not predictions, they are conditions. A good risk manager does not need to predict the exact crisis. He needs to understand what conditions make the system fragile and then reduce exposure to those conditions. That is the essence of preparation, not prediction, preparation. Now, what does that mean for where to store cash? It means cash should be treated as a portfolio with different roles. Some cash is for immediate access, some cash is for emergency spending, some cash is for investment opportunities, some cash is for preserving optionality if one bank has trouble. Some cash is for reducing exposure to one currency. Some cash is for protecting against inflation. Those are different jobs. One instrument cannot do all of them well. A checking account is good for payments. It is not ideal for large uninsured balances. A savings account is convenient. It may lose purchasing power after inflation. Treasury bills can reduce bank risk. They may not be as instantly usable for everyday needs. Physical cash is useful in a short-term access disruption. It is poor for large long-term storage. Gold may hedge monetary disorder. It is not convenient for paying bills. Foreign accounts may add jurisdictional diversification. They require compliance and careful planning. Real assets may preserve value through inflation. They are not liquid emergency cash. So the right question is not where should I put all my cash? The right question is what problem is each layer solving? This is how I would think about it. Layer 1 is operating liquidity. This is the money used for bills, spending, payroll, and daily life. It needs to be in a normal bank account because life requires convenience. The goal is not to eliminate banks. That is unrealistic. The goal is to use banks intelligently. Layer 2 is insured liquidity. This is cash that remains within deposit insurance limits spread across institutions or ownership categories where necessary. The purpose is to reduce the risk that one bank failure creates a major loss. Layer 3 is government-backed liquidity. Short-term treasury bills or similar government obligations can reduce private bank counterparty risk. This layer is not for every daily transaction. It is for storing cash, like value with a different kind of exposure. Layer 4 is emergency physical liquidity. A reasonable amount of physical cash can be useful if cards do not work, banks are closed temporarily, or electronic systems are disrupted. This should be sized prudently and stored safely. Too little creates dependence, too much creates theft and inflation risk. Layer 5 is monetary hedge. Precious metals or other hard assets may protect against currency debasement or loss of confidence in money. They should be understood as hedges, not magical solutions. Layer 6 is jurisdictional diversification. For those with the need, the means, and proper compliance, foreign accounts or foreign currency exposure can reduce dependence on one national system. This must be done legally and with professional guidance. Layer 7 is productive long. Term wealth, cash is not the end goal. Over long periods, productive assets are what preserve and grow purchasing power. Businesses, equities, real estate, and other productive investments matter because inflation punishes idle money. This layered structure is not a recommendation to any specific person. It is a way of thinking. Different people need different layers, different sizes, and different levels of complexity. A retiree with modest savings does not need the same structure as a business owner with payroll risk or a family with international assets, but everyone should understand the principle. Single point dependence is fragile. Layered access is resilient. Now let us return to the psychology. The banking system is designed to feel safe. The buildings are solid. The language is reassuring. The accounts are easy to access. The app shows your balance. Regulators issue statements, deposit insurance. Logos appear on websites and branch doors. That confidence is important because banking depends on confidence. But confidence can become complacency. People stop asking what they actually own. They stop asking who the counterparty is. They stop asking what happens above insurance limits. They stop asking how fast they can access funds. They stop asking what happens if the bank assets fall in value. They stop asking what happens if regulators impose a resolution plan. Then a crisis arrives, and they discover the real rules under stress. That is too late. The time to read the contract is before the crisis. The time to understand deposit insurance is before the bank fails. The time to spread risk is before withdrawals accelerate. The time to build access to treasuries is before you need liquidity. The time to keep records is before accounts are frozen. The time to decide how much cash to hold physically is before the ATM line forms. The time to think about inflation risk is before cash has lost purchasing power. In finance, the preparation that feels unnecessary in calm conditions often becomes priceless in stress. But there is a balance. Too little preparation is dangerous. Too much fear is also dangerous. You do not want to live outside the system entirely. The system has benefits. Banks are useful, digital payments are useful, markets are useful, government securities are useful, insurance is useful, regulation is useful. The goal is not to reject the machine. The goal is to understand the machine well enough not to be crushed by it when it behaves according to its design. A bank is a leveraged institution. A deposit is a liability of that institution. Deposit insurance is a confidence mechanism with limits. A bail-in is a loss distribution mechanism. A central bank facility is a liquidity mechanism. A bank run is a confidence collapse. A cash strategy is a resilience mechanism. Once you name the mechanisms clearly, the fear goes down. You can think. The problem with most public discussion is that it swings between two extremes. One side says everything is perfectly safe, do not worry, trust the system. The other side says everything is collapsing tomorrow, take all your money out immediately. Both are too simple. The system is neither perfectly safe nor useless. It is powerful, useful, and fragile under certain conditions. That is the truth. And the truth leads to a measured response. Understand insured limits. Avoid unnecessary uninsured concentration. Use high-quality institutions. Consider short-term treasuries or government money funds where appropriate. Hold some emergency cash, but not too much. Avoid thinking gold solves every problem. Avoid illegal or sloppy offshore behavior. Keep documentation. Maintain access to more than one financial channel. Think about inflation and purchasing power. Think about liquidity, not just safety. And do it before stress. The 1929 farmer did not lose money because he was foolish. He lost money because the system he trusted failed in a way he did not understand and could not control. That is the hardest lesson. Good character does not protect you from bad structure. Hard work does not protect you from bank failure. Saving does not protect you if the institution holding the savings collapses and there is no backstop. Being responsible is not enough if responsibility is defined only as putting money in a bank and never asking what happens next. Real responsibility includes understanding the counterparty. This is not a lesson only for farmers in 1930. It is a lesson for depositors in every era. In Cyprus, people learned that uninsured deposits could be converted into bank equity. In Argentina, people learned that bank balances could be frozen and currency terms could be changed. In 2008, people learned that safe-looking securities could hide enormous risk. In 2023, people learned that regulated banks can still fail quickly when duration risk, uninsured deposits, and confidence collapse meet. Each era gives the same lesson in a new language. Do not confuse normal access with guaranteed access. Do not confuse convenience with safety. Do not confuse regulation with invulnerability. Do not confuse a bank balance with money sitting in a vault. Now, let me be clear about one more thing. A banking crisis is not the only risk to cash. Inflation is the slower crisis. If you hold too much cash for too long and prices rise steadily, your purchasing power declines. You may avoid volatility, but you do not avoid loss. The loss is simply hidden inside the currency. This is why the question of where to store cash cannot be separated from the question of why you are holding cash. Cash for 6 months of expenses is different from cash meant to preserve wealth for 20 years. Cash for a business payroll cycle is different from cash waiting to buy assets in a downturn. Cash for emergency access is different from cash held because you are afraid of investing. When people do not define the purpose, they misuse the tool. Cash is a tool, not a religion, not a permanent strategy, not a complete safety plan. It provides liquidity and optionality. It should be protected from bank risk where possible, but also protected from inflation by not holding too much for too long without a reason. This is where many people make the opposite mistake from the depositor who trusts banks blindly. They withdraw too much cash, sit outside the system, earn nothing, take theft risk, and lose purchasing power year after year. That is not resilience, that is fear. A good cash plan is balanced, enough inside banks for convenience, enough insured or diversified to reduce institutional risk, enough in short-term government instruments for stability, enough physical cash for disruption, enough hard assets or productive assets to protect long-term purchasing power, enough flexibility to respond. That is how you avoid both complacency and panic. The important thing is to recognize the system's true nature. Banking is a confidence-based credit system. It creates money through lending. It expands during trust. It contracts during fear. It relies on short-term funding and longer-term assets. It is stabilized by deposit insurance, central banks, regulation, and government credibility. Those stabilizers are real, but they are not magic. They work best when the crisis is contained. They are tested when the crisis is broad. That is why systemic crises are different from isolated failures. If one small bank fails, the system can absorb it. If many institutions fail or if confidence breaks broadly, governments and central banks must choose among difficult options. Print, guarantee, merge, restrict, bail in, bail out, inflate, or let losses fall. None of those options is painless. The cost is always paid by someone: taxpayers, depositors, currency holders, bondholders, shareholders, future generations. The cost does not disappear. It changes form. Understanding that is essential, because when a government says it has solved a banking crisis, you should ask how. Did it protect depositors by creating money? Then currency holders may pay through inflation. Did it impose bail-ins? Then creditors and uninsured depositors paid directly. Did it guarantee everything? Then moral hazard rises and future risk may increase. Did it let banks fail? Then depositors and local economies pay. Did it freeze withdrawals? Then access was sacrificed for stability. Every solution distributes pain. The question is whether you are positioned to absorb less of it. That is the practical purpose of preparation. Not to escape all risk, to avoid being the easiest source of loss when the system needs someone to pay. Now, if you look at the modern world, the pressure points are visible. Banks hold securities whose market values can fall when rates rise. Depositors can move money faster than ever. Large uninsured balances exist in many institutions. Commercial real estate stress may pressure some banks. Government debt levels are high. Central banks are constrained by inflation. Digital communication can accelerate panic. Financial institutions are interconnected. These conditions do not guarantee a crisis, but they create fragility, and fragility means that preparation is rational. One of the biggest mistakes people make is waiting for certainty. They say, tell me exactly which bank will fail and when, and then I will act. That is not how risk management works. If you know exactly which bank will fail tomorrow, it is no longer risk management, it is emergency response. Risk management happens under uncertainty. You act because the structure contains vulnerabilities, not because you know the exact failure date. That is how I approach banking risk. I do not need to know whether a particular bank will fail. I need to know that deposits above insurance limits are exposed. I do not need to know whether a systemic crisis will happen this year. I need to know that the insurance fund is not designed to cover everything at once. I do not need to know whether the government will impose a bail. And I need to know that bail-in rules exist and can be used. I do not need to know whether inflation will accelerate. I need to know that cash loses purchasing power when money is debased. I do not need certainty. I need enough understanding to build resilience. That is the difference between speculation and prudence. Speculation says, I know what will happen. Prudence says, I know what could happen, and I will not be fragile if it does. The 1929 lesson is not that you should never trust banks. The lesson is that trust should be informed, not blind. Deposit insurance made the system stronger. Regulation made the system more stable. Central banks learned from past failures. Modern banks are not the same as small banks in 1930, but stronger does not mean unbreakable. And because the system is more complex, the failure modes can be more complex too. A bank may not fail by closing its doors with a handwritten sign. It may fail through a weekend resolution. It may be merged. It may be backstopped. Deposits may be guaranteed. A facility may be created. A new rule may be invoked. Access may return Monday morning, but you still need to know what part of your money is exposed, delayed, uninsured, or dependent on discretion. That is the modern version of the same lesson. The language is different. The risk is still about access, solvency, liquidity, confidence, and priority of claims. Who gets paid first? Who waits? Who is insured? Who is uninsured? Who depends on emergency discretion? Who has documents? Who has alternatives? Who has optionality in a crisis? Those questions matter more than the number on the screen. So if you are holding cash today, think about it carefully. Do not simply ask whether the bank is famous. Famous banks can fail. Do not simply ask whether the app works. Apps work until the system behind them is stressed. Do not simply ask whether the government has insurance. Insurance has limits and procedures. Do not simply ask whether your balance is visible. A visible balance is not the same as liquid money under stress. Ask deeper questions. How much is insured? How much is above the limit? How many institutions hold my cash? What is the quality of those institutions? Do I need immediate access to all of it? Would treasury bills be appropriate for part of it? Do I have emergency cash outside the system? Do I have too much cash losing to inflation? Do I have records and beneficiaries organized? Do I have a plan if one bank account is frozen or unavailable? These questions are not dramatic. They are basic, but most people never ask them. They only ask after the line forms outside the bank. The goal is not to become obsessed with disaster. The goal is to make the disaster less decisive if it comes. A good plan quietly reduces the consequences of being wrong. If there is no crisis, you still have a sensible cash structure. If there is a crisis, you have options. That is the best kind of preparation, useful if nothing happens, critical if something does. When I look at the long arc from 1929 to today, I see the same pattern. The public is reassured. The system works, trust grows, risk accumulates. A shock arrives, the weak point is revealed. Rules are changed, confidence is restored. Then people forget. That forgetting is part of the cycle. Each generation believes the last crisis cannot happen again because the last crisis now has a new regulation attached to it. But systems rarely fail the same way twice. They fail through the part people are not watching. The next banking problem may not look like 1930, it may not look like 2008, it may not look like Cyprus. It may not look like Silicon Valley Bank, but it will still involve the same core ingredients. Leverage, maturity, mismatch, confidence, liquidity, counterparty risk, government response loss distribution, and human behavior. People will still say they never saw it coming, but the mechanics are visible. Now, if you are willing to study them, that is why history matters. Not because it gives you a perfect prediction, because it gives you a framework. A framework lets you interpret events instead of being controlled by them. When a bank fails, you do not panic. You ask which deposits are insured, which are not, what the resolution mechanism is, whether there is systemic risk, and what your exposure is. When inflation rises, you do not simply sit in cash because it feels safe. You ask what real purchasing power is doing. When treasury yields move, you ask what that does to bank balance sheets. When regulators create emergency facilities, you ask what problem they are trying to hide or stabilize. When people tell you everything is safe, you ask under what conditions. That phrase is important. Under what conditions? Everything is safe under some conditions. Almost nothing is safe under all conditions. A bridge is safe under the weight it was designed to hold. A bank is safe under the withdrawal behavior it was designed to handle. A deposit insurance fund is sufficient under the failure scale it was designed to cover. A currency is stable under the discipline its issuer maintains. Change the conditions and the conclusion changes. That is systems thinking. And it is the only way to think clearly about money. Most people want a simple answer. Keep cash here, buy this, avoid that, trust this, fear that. But reality is more nuanced. Cash in a bank is useful but not unlimited safety. Cash outside the bank is useful but not long-term wealth protection. Treasuries are strong but not free of all practical limitations. Gold is useful but not riskless. Foreign accounts can help but require compliance. Real assets preserve certain values but sacrifice liquidity. A resilient person uses tools for their proper purpose. The wrong tool used for the wrong job creates risk. Now let me return to the farmer. The tragedy of the Nebraska farmer is not only that the bank failed, it is that he had no alternative. His year of labor was concentrated in one institution. There was no insurance, no rapid government resolution, no electronic transfer, no treasury direct, no diversified brokerage, no emergency facility, no second bank account, no liquidity layer. When the door closed, his financial life closed with it. The modern person has more tools. That means the modern person also has more responsibility. If you have access to multiple banks, use that intelligently. If you have access to treasury bills, understand them. If you have access to insured accounts, know the limits. If you have access to brokerage cash tools, understand their structure. If you have access to physical cash, size it sensibly. If you have access to global diversification, use it legally and carefully. If you have access to information, do not ignore it. History is a teacher, but only for people willing to be taught before the exam. The next crisis will not ask whether you were a good person. It will ask how your assets were structured. That is not fair or unfair. It is how systems work. And because systems work this way, the best response is calm preparation, not withdrawing everything, not trusting everything, not buying one asset and calling it safety. Not assuming the government will always make everyone whole. Not assuming the government will never make anyone whole. Not assuming inflation is gone. Not assuming banks are bad. Not assuming banks are invincible. Just a clear view of the machine. The bank takes deposits and creates liabilities. It lends and invests. It earns spreads. It depends on confidence. It is protected by insurance, regulation, and central banking. It can still fail. Depositors are protected up to limits. Above limits, outcomes depend on resolution. Cash alternatives have trade-offs. Diversification reduces but does not eliminate risk. That is the truth. The rest is storytelling. In calm times, truth feels unnecessary. In crisis, truth becomes the only thing that matters. So before the next banking stress, do the work. Review your accounts. Check insurance limits. Reduce unnecessary uninsured concentration. Learn how treasury bills work if they fit your situation. Keep a reasonable emergency cash layer. Think about inflation and purchasing power. Consider whether you need more than one institution. Keep records. Understand who your counterparties are. Ask what happens if access is delayed. Ask what happens if the bank fails. Ask what happens if the currency weakens. Ask what happens if everyone wants out at the same time. That last question is the oldest banking question when too many people want out at the same time. Not everyone can get out through the same door. A good plan gives you more than one door. That is the final lesson. Not fear, not conspiracy, not prediction structure. The banking system is a machine. Machines do what they are designed to do. Fractional reserve banking creates credit and growth. It also creates fragility. Deposit insurance creates confidence. It also has limits. Emergency facilities stabilize panic. They also shift costs, bail-ins protect taxpayers. They can expose creditors. Cash provides access. It can lose value. Gold preserves outside money. It can be restricted. Treasuries reduce bank risk. They introduce other considerations. Every tool has a role. Every tool has a weakness. A resilient cash strategy recognizes both. That is how you avoid becoming the person knocking on the bank door after it is too late. The next crisis will come at some point. I do not know when. I do not need to know when. The question is not whether the future will contain stress. It will. The question is whether you understand where your money actually is when stress arrives. If your answer is simply it is in the bank, then you have not finished thinking. If your answer includes counterparties, insurance limits, liquidity layers, government obligations, emergency access, inflation protection, documentation, and alternative channels, then you are beginning to see clearly. Seeing clearly does not remove risk, but it lets you manage it. And in a world built on confidence, managing risk before confidence breaks is one of the most valuable things you can do.